3 stocks at 52-week lows. These are 3 of the darlings from the past: Tesla, Lucid, and Coinbase. If I had told you when Tesla was at $402 a share back here in early 2022, that today it would be sitting at $169 and the market cap of the company would be a little bit over $530 billion, you would have had called me absolutely crazy. And that is the situation that we are in right now. Hit a 52-week low yesterday. Now, same thing for Lucid. This is a company where Stock Mo told you to buy up here and probably over here, and now we're sitting at $10 a share, right? I mean, come on. This is a company that barely has any cars on the road, and their cheapest car that they have is $87,000. I've said this in the past. Yes, Tesla started by having a very expensive car on the road, and actually the Roadster, and then the Model S. It worked because they were the only game in town. Now, Audi has a car, BMW has a car, Porsche has a car. Obviously, Tesla has tons of cars on the road that are much less than $87,000. You're not going to make it as a car company to be a legit car company if you're going to have the cheapest car being $87,000. It's just not going to happen. So their 52-week low happened yesterday, $9.98, 52-week high, $56.70. And of course, the darling of them all, the saga continues with FTX, Coinbase. So we have had many people come out and say that there is contagion going through the crypto market, and that is a reason why Coinbase is getting hit. Coinbase hit a 52-week high of $331, and the high was $429. And Jim Cramer, on this day, I think it was April 13th, he said $479. That's where he liked it. That's where he tweeted. He liked Coinbase to $479, and today it's sitting at $44.13. So maybe what he meant is this. He just accidentally added something in there, a digit, but that's okay. We'll just deal with it. All right, so Coinbase. Here's the problem with Coinbase. There's not enough information. So anything that you do here is going to be speculative because there's so little data on the company. Also, do you really want to bet on a company that just came out of nowhere, had incredible revenue growth? Why? Because crypto was booming, and now crypto is boom, bust. But do you really want to bet on a company like this? What you're saying is, I'm putting a bet on the crypto industry. That's exactly what you're doing. And no matter which way you want to cut it, you are putting a bet on the crypto industry if you get involved with Coinbase right now. Lucid, I've talked about its problems. Do they have an awesome car? Absolutely, they have an awesome car. Are they seeing revenue growth? Yes, they're seeing revenue growth. Are they seeing net income growth? No. Are they seeing cash flow growth? Let's see. No. So to me, you're looking and saying, okay, I'm going to put my bet on a company that has a car that is $87,000, actually plus, I think it's like $87,400. And I'm going to bet on them to compete with the big guys like GM, Ford, Tesla, Audi, Porsche. The list goes on. Toyota's going to come out with an electric car. Honda's going to come out with an electric car. And I'm going to say, yes, this is going to work. And the high-end car is $250,000 plus dollars. Okay? I just don't see what you're doing here. If you want to look for a multi-bagger that's going to be like a 5,000 bagger, there's definitely better options out there. Now, Tesla. When this was at $200 a share, actually, you know what? Let me figure out what the actual price was, because today's date is November. Let's say Tesla was probably at $250. Let's call it $250. When it was at $250, I sold puts on this thing at $50 a share for January of, so it was 1/20 of 2023. And my friends literally berated me and called me an idiot. Justified? Sure, I could take it. Now it's at $169.58. They just told me last week that I'm still crazy to think that this is going to $50 a share. Well, when this was sitting at an all-time high of $402.67, if I would have told you I'm putting bets on Tesla at $175 a share, they would have called me stupid and crazy. $150 a share, stupid and crazy. I don't think this is really out of the realm of possibility. Could it never happen? Absolutely, it could never happen. But I guarantee you, this is what the excuse is going to be. When Tesla gets any lower than this, call it sub 100, the excuse is going to be, well, Elon is just focusing all on Twitter. He took all, and we didn't work it into our projections. Okay, if that's the excuse you want to live and die on, go for it. Let's see what the analysts have to say going forward. Earnings per share growth. Going out 5 years, they're still seeing 32. I mean, that's incredible growth for this company. And I actually can see it. I have 2 Teslas, Model 3 and a Model S, and they're good cars. The quality of the cars is kind of terrible, but the technology is fantastic, and driving the EVs is really fun. Revenue growth going out, let's call it 20%. So let's do a stock analyzer tool on Tesla over the next decade. So these numbers that I put in is what Tesla is going to do over the next decade for me to get my desired return. And remember, my desired return could be a little bit higher because I really want to make sure that the juice is worth the squeeze on this thing. That's my margin of safety. So for revenue growth, let's put in a wide range of numbers. Let's do 10, 15, and 20 on that high side. Profit margin. Now, the profit margin is a little bit difficult to do. And let's check the 8 pillars here. I mean, the shares outstanding, they're diluting the heck out of you. First things first. They're absolutely diluting the heck out of you. So they did say they're going to do some kind of nonsense stock buyback, but yeah, I don't know. What's their gross margin? Gross margin of 26.6%. So let's get back to it. Profit margin. Let's do 4, 8, and 12. Free cash flow margin should equal out over that same period of time. And PE, I will do 15. Nope. You know what? I'm going to go high. I'm going to go 16, 18, and 20. Okay. Just to appease some people out there. And that's not even close to appeasing. 13, 15, 17% return. Current stock price, $169. Basically the 52-week low. $18 on the low end, $96 on the high end, and my middle ground is about $50, and you can see it's on my watch list at $100. Why is it on my watch list at $100? Because when it gets to $100, I want to be able to sell shares somewhere in this range right here. So it's going to give me more premium to sell shares at 50, 45, 40, 35, etc. I don't think I would get shares around these prices because I do think when Tesla's share price comes down to about $50, that's when stock price and valuation are going to match up and it'll start to climb again. That's what I think is going to be going on. I don't think that I'll be getting shares at $35, $25, etc. But why not collect premium down here at these ridiculously low numbers? Because I do think that Tesla is worth somewhere around 50, and when it gets to 50, it's going to be a great value. So guys, just because stocks are at 52-week lows doesn't mean you go buy them. They can get much, much cheaper. Because as crazy as this was, pull up the S&P, as crazy as this run was from 2020 all the way up here, this is just as crazy to fall, but it will absolutely happen. Don't think that just because stocks have fallen from these peaks means that they're cheap here. No, it might take for them to get here to be cheap. Subscribe to the channel, guys. We do a lot of videos like this. See you later.